Stocks versus real estate. Dividends versus rent. There hardly is a person that has been even remotely interested in investing or in receiving passive income that has not heard of buying stocks or rental properties. In this video, I will give you my view as a person who receives both rent from rental properties and dividends from his stock portfolio. I will leave no stone unturned and we will compare the two types of investments. By the end of it, you will have a clear understanding of the pros and cons of each, what strategy is best for you, and what is my opinion of it. Now, the reason why I am comparing these two is that they are the most historically proven and famous wealth creators. And when you think about it, it makes total sense. Wealth is created by providing products or services to society, and there is no way you can do that without businesses, which are represented by stocks, and or land, which is represented by real estate. However, one of these two is way closer to people's mind than the other. The reason is that it is less abstract and closer to their daily lives. Of course, I'm talking about real estate, which is why I will start with its advantages over stocks. The first advantage is that the real estate market is way less efficient than the stock market, and so you can always get a deal if you have information that the others don't. For those who are newer, efficient market means the extent to which all of the market participants have the same amount of information in the same amount of time. When it comes to stocks, especially the big ones, the market efficiency is way higher because they are scrutinized by thousands of analysts and millions of participants all the time, and are also required by law to disclose their financial statements and different kinds of reports. That makes it a lot harder, not impossible, but harder to take advantage of information asymmetry. However, that's not the case with a local property. If you have been living in that area for some time or have connections with agents who give you the right information, you can definitely know things that the buyer of the same property will not know. A very real example is, let's say that you are selling your apartment and the buyer asks you whether the neighbors above are loud. You can choose whether to say yes or no, and there won't be an easy way for the buyer to verify your answer. If you say that your neighbors are perfect, when in fact they are extremely loud, this will allow you to get higher price than if both you and the buyer knew that they're throwing wild parties all the time. This is just one example, but you can extrapolate that to almost everything, like the local nightlife, how loud the public transport system is, how often the garbage is being collected, etc., etc. It's very hard to do that for, let's say, a company like Apple, unless you are some kind of an insider. Another advantage of real estate is that you have a lot more things on the micro level than you can control. Remember that I said on the micro level because this will become important later in the video. You can pick the tenants yourself, you can decorate a certain room in a certain way, which could potentially increase the rent. You can even try to advertise the property to a certain type of buyer that would be willing to pay more for a certain location, house, etc. This is impossible in the stock market, where unless you work in a certain company, there is literally nothing you can contribute to the business with. There is not a single thing I can do to help Chevron extract more oil or Procter & Gamble to manufacture more pieces of shampoo. However, you need to understand that on the flip side of the coin of more control stands more work. The fact that you can do all these things also means that you have more responsibilities towards the individual property. If I go back to the previous examples, the fact that I cannot do anything to help Procter & Gamble manufacture more shampoo also means that I have no responsibility for the process. However, the fact that I can change the roof of my property means that I am responsible for it when it starts to leak. And here it's important to make the distinction between passive investing and having real estate as your business. What I'm talking about is not fixing and flipping or managing an Airbnb property yourself, because to me, this is a business, not an investment. Repeat after me. This is a business, not an investment. Anytime in your investment journey, when you confuse the two, you'll be in a lot of trouble. A third undeniable advantage of investing in real estate is that you can use debt. If I go in the bank and ask them to give me $100,000 so that I can invest in the S&P 500, now, while I haven't actually tried it, I'm pretty sure I will get laughed at. However, it's absolutely normal to go in the bank and ask for a mortgage, with which then you buy property, which then you find a tenant for and start receiving rent. That means that if this particular piece of property does well, you will be able to participate in the upside to a much greater degree because of the use of leverage. At the same time though, you have to remember that leverage cuts both ways. If the value of the property or your rent starts going down and you cannot cover the mortgage payment, well, you can ask the investors who were investing through the financial crisis in 2008 how fun that is. Another big advantage of real estate is the tax benefits. This is going to be completely different in different countries, obviously, because each country has its own tax laws and you should check what yours are. However, in the USA, for example, you can use what is called depreciation and have it as a tax write-off. Depreciation means that the tax authorities are acknowledging the fact that even though the market value of your property might be increasing, the building itself is depreciating in value because it is a structure that needs maintenance. Therefore, you can deduct that depreciation from your annual income and pay less taxes even though you are making money on the investment. I have an investment in a private real estate fund in the USA, and I remember the first few years I was receiving around 8% on my initial investment, but there were no taxes. The reason for that was that the depreciation of the properties was creating such a tax write-off that it made the profit non-taxable. Weird American laws. The last real big advantage of real estate that I personally see is that it is very easy to understand. All of us need to live somewhere or go to shops or gyms, which also need buildings in order to function. And so it is very natural and close to us. Now, since I have an international audience, this might or might not be exactly true for you, but stocks are a lot more abstract for the majority of people. This is less true for a country like the USA, where investing in the stock market is way more common. However, even there it requires a little bit of abstract thinking to understand what stocks do, whereas literally every single person can understand what real estate does because they need to go somewhere to sleep at night. In other places, like for example my country Bulgaria, which is in Eastern Europe, we barely even have a single generation that has grown up with a local stock market, and so everyone is obsessed with putting their money in real estate, not necessarily because it's the best thing, but because it's the only thing they know. However, there, in my opinion, also lies the biggest trap of real estate. When I talk with a lot of people about investing in stocks, the main issue I see is that they're afraid they don't know enough and they cannot control how the company or the ETF does in the future. For those that are new, an ETF stands for Exchange Traded Fund and is simply a basket of a lot of companies picked according to a certain criteria. However, when they buy an apartment in the town they live in, they feel a lot more secure in their investment because they assume they know a lot and have a lot more in their control. For anyone that thinks that way, I will challenge you on that. The truth is that this is a classic example of familiarity bias. This is a term from psychology, which basically means that when faced with decisions, people tend to favor the more familiar path, not because they have done all the rational research, but just because it is closer to them. So according to that familiarity bias, you would naturally think that the apartment in your town is a way safer investment than, let's say, a fund that has 100 companies in it. The reason is that you can go and touch the bricks in the apartment, you control the keys for it, you can open and close the door, you grew up on the street, etc., etc. However, let's examine what you actually do control. Well, apart from whether the door is opened or not, pretty much nothing. You don't control what your neighbors are going to do. You don't control whether that beautiful view from your window will be covered by construction next year. You don't control the crime rate in the neighborhood or whether it turns into a ghetto. You don't control the economy of the town. You don't control the birth rate. You don't control the school system. You don't control the immigration policies. I can go on and on and on. But I think that's enough examples for you to understand how this familiarity bias tricks people. If we compare an investment like that with an ETF that has the 100 biggest companies in the world in it, and we start thinking rationally, you will quickly understand what I mean. If you ask the average person, they will tell you that they don't know enough about those ETFs or companies. However, how many people who invest in real estate have actually done research on the birth rate trajectory of the town or the country, for example, which will of course influence the demand for real estate? Or how the business of the main local employer is doing, which provides work and also influences how many people want to live there. Or how many empty apartment units there are, which could be rented out tomorrow and will lower the rent on your apartment, etc., etc. And by the way, I'm completely guilty of that myself. When I purchased my first rental property years ago, I didn't analyze any of these things. I just assumed that if I want passive income, I need to buy real estate and that's it. But just like I realized afterwards, if you stop and think about it, you will quickly find out that you literally know as much about this real estate investment as you do about these hypothetical 100 stocks from the ETF I just talked about. However, for some reason, people think it's riskier to invest in a collection of companies like the ones that dig oil and gas out of the ground, create the computers and software that we work on, manufacture the cosmetics that we use on a daily basis, or make the drugs that save our lives. This is not based on rational thinking or evaluation of facts, but entirely on the psychological phenomenon called familiarity bias that I just explained to you. All of that leads me to one of the main advantages of investing in stocks: diversification. Diversification is one of the most important concepts that you need to understand in investing. It means spreading your capital in different places so that if one of these investments goes wrong, you don't go to zero. And so now if we follow this principle, try applying it for real estate investing. Unless you have something like $8, $10, $15 million sitting around, it's really hard to diversify with real estate. Let's say you have a couple $100,000 and you're able to buy 2 apartment units in 2 different cities. Well, now first you're going to have the headache of owning a property not in the place where you live, and you have to appoint a manager of it, basically work with an agency, and then make sure that the agency isn't screwing you in any way because you have no visibility over the property. Or you will have to travel every time you have an issue with the apartment. And even in that case, your whole investment is still in only one country. I don't think when people invest in real estate, they actually realize how extremely concentrated their investment is. Perhaps they don't feel that way because of the familiarity bias, but think about it for a second. Let's say you buy a big apartment unit and this is all of your investment. It costs you $300,000 or euro, it doesn't matter. Well, this is one apartment in one building, in one street, in one neighborhood, in one city, in one country. Just think about that for a second. I think for the people listening who are already investing in the stock market, they can more easily appreciate what I'm trying to describe here. Imagine that 100% of your portfolio is in only one stock. Every single piece of advice you will read, every single consultant that you talk to will tell you that you are crazy because you're putting all your eggs in one basket and you should diversify. And they would be completely right. However, let's imagine for a second that this company is Microsoft. So you have a $3 trillion company that is in half of the homes in the world. That is one of the leaders in enterprise software, one of the biggest technological innovators of all time, one of the 3 companies that dominate the United States cloud market. If you think about it, this is pretty diversified in itself, but still putting 100% in it is crazy. But for some reason, people think that it's completely okay to put all of your money in a bunch of bricks, in one building, in one town, in one country. It's insane to me. What happens if the local employer goes out of business? What happens if there is a flood and your apartment is not insured? Or even if it's insured, it takes you years to recover your money and you never get paid the full amount. What if the country you're in decides to allocate people of certain ethnicity that are, to put it gently, not exactly law-abiding citizens? Your whole portfolio gets destroyed. This problem can easily be avoided with a bunch of stocks or even an ETF that holds hundreds of companies in it, giving you instant diversification that you can never even dream of with real estate. And by the way, if you still want to invest in real estate, there is something called REIT, which stands for Real Estate Investment Trust. These are companies that hold real estate and distribute the profit of the rent to you in the form of dividends, but are traded on the public markets, and so you can buy them as normal stocks. Even one of these companies can give you way better diversification, and you can have a portfolio of dozens of them. I will give you a simple example, which is not a recommendation to invest in the company in any way, but just for illustrative purposes. Now, for full transparency, at the time of recording this, I have this REIT in my portfolio. I'm talking about Realty Income, which is one of the most famous real estate investment trusts and has over 15,000 properties in its portfolio. These properties are located in all of the states of the USA, France, UK, Germany, Italy, Spain, and Portugal. The company has all sorts of properties like grocery stores, gyms, logistical centers, and even vertical farms, data centers, and casinos. Let's say that a flood happens in Miami and destroys 4 gyms, 3 retail stores, and 1 logistical center. Well, the company will still have over 15,440 properties left out of the initial 15,450. And this is just one company. As I said, an investment portfolio can have dozens of them. And so speaking of diversification, because of the lack of such, when you buy real estate, you should always search for the so-called risk premium. Risk premium in investing means being compensated for taking higher risk. It is a basic concept. If you assume higher risk but are getting paid the same amount as with an investment with a lower risk profile, then it doesn't make any sense. And since I think we can all agree based on what I have laid out this far, that mainly due to the concentration real estate is way riskier, we should always get compensated for that risk. Now, since the real estate market is extremely diverse and vast, and this channel is watched by people from all over the world, I will simply give an example with my country, Bulgaria, and you can apply that principle to your local market. Here in the capital Sofia, which is also the biggest city, currently a lot of apartments give you roughly 3 to 4% in rent. Now, whether real estate here is overvalued or is realistically priced is something that is debated all the time, and I don't need to get into that. However, we can compare the rent income with what we get as a dividend yield from the previously mentioned REIT, realty income. Dividend yield means the percentage on our money we get as cash in our account when we invest in a stock, just like you would receive rent in your bank account from your property. So here is realty income's current dividend yield. It stands at 6%. So isn't it weird, let's say, to use my example, as a Bulgarian investor who wants to buy real estate in the capital Sofia, to accept 4% rent income from one apartment in one neighborhood in one city in a country in Southeastern Europe, which, although is a NATO member, sits at 150 kilometers away from a war zone, while a real estate investment trust with over 15,000 properties situated in the USA, UK, Germany, France, Spain, Italy, and Portugal gives me 6%. I mean, I simply find that hard to justify. Also, this stock has raised its dividend for 26 years, every single year, at an average rate of over 4% per year. The same cannot be said for the rents in my country. And even if the rent in your country is higher as a percentage, always remember that if you own one apartment, it only takes that one person to live, and then you can spend months without any income from the investment. How do I know this? Well, because it has happened to one of my rental properties that I own. It took me 4 months to find a new tenant, and I had to lower the rent with 10% and keep it that way for 2 years before I could bring it back up again. The chances that 100 or even thousands of businesses that occupy these over 15,000 properties in a REIT will all stop paying their rent at the same time is basically close to zero. Again, understand that I'm not saying that you should buy this company or that it will be forever in the shape that it is right now. I'm just giving it as an example to illustrate the principles of diversification and risk premium. If you want more help with the start of your investing journey, or more clarity if you are already an investor, then I invite you to join my free investing masterclass, where I go into a lot more details on the topic of dividend investing for passive income. I compare it with real estate investing and also with other strategies. I also do a deep dive on how our money works, and I explain why we live in a world where normal people cannot save money anymore. I talk about the concept of inflation, money printing, and more. In the masterclass, I share how, unlike with real estate, it is possible to start investing even if you don't have a lot of money or previous financial education. So if that sounds interesting and useful to you, you can find the link in the description. Thousands of people have already been at the event, and I have received overwhelmingly good feedback, so I'm sure you will like it as well. Alright, let's now go to the next advantage of dividend stocks over real estate, and that is the compounding effect. For all the people who hate math, don't worry, it's pretty simple. Compounding is one of the greatest forces in investing. What it basically means is that if you have an investment of $100 and it gives you $10 in cash, this is basically 10%. If you reinvest those $10, you will now have an investment that is worth $110. And if that investment gives you 10% again, this time you will not receive $10, but 11. This is because 10% is now calculated out of the new $110, not the previous 100. And so if you reinvest it again, you will have $121, which means that if you get 10% on that again, you will get $12.10 in cash. And the longer this goes on, the more dramatic the growth becomes. When you have dividend stocks, even if it's a very small portfolio, you can take full advantage of what I just described. This is because you can buy shares of companies or ETFs for $20, $50, or $100. And even if the shares are more expensive or you have less money, the modern brokerages allow you to purchase what's called fractional shares, which means that you can buy $5 out of $10 share and you simply have half of a share from that company. This is unlike with real estate, where you either have a couple $100,000 or you don't. And if you don't get to play the game at all. When you have $1,000 in dividend stocks and you receive $100 in dividends, for example, you can choose to reinvest them and grow your portfolio to $1,100, which will kickstart the compounding effect. If you have $1,000, you cannot even dream of buying a property. But let's say you have $200,000 and you're able to buy an apartment you receive rent from. Well, if you receive $10,000 per year in rent, you will have to wait 20 years before you buy your next apartment with the rent. And by the time those 20 years have passed, the price of the apartment will probably now be way more than the $200,000, so you actually can never take advantage of the compounding effect I just talked about. You cannot take your rent and buy 2 square meters of a property, which will then generate $7 per month for you, etc., etc. It just doesn't work that way. However, with dividend stocks, you can. The next advantage of dividend stocks is that dividends are way more passive than rent. When you buy shares of a company, let's say it's Coca-Cola, again, not an investment advice to invest in Coca-Cola, but just an example, you will get money in your account every 3 months. There is literally nothing you can do to help their business unless you work there. If you go to one of their, let's say, factories, show up at the front door and say, hey, I'm a shareholder of Coca-Cola, let me help you with your business. As you can imagine, you probably get kicked out by the security. This is a company that has existed for over a century, and there is nothing you can do to contribute to their business, which also means that it makes the income truly passive. Now, of course, you have to initially know how to research the company, what metrics to follow, and then from time to time check how they're doing, which are all things that I discuss and teach people how to do in my dividend method program. But as I mentioned, if you want to truly research your real estate investments, you kind of need to do that for your local area, city, or country regardless, so there is no escaping it. And yes, I know, you can hire a property management company, but again, ultimately, it is your property and you need to take care of it. I'm saying this as a person who receives both rent from rental properties and dividends from dividend-paying stocks and funds, so I'm speaking from experience. If you're finding value from this video, then I invite you to like it and also subscribe to the channel with the notification bell so that you are directly notified about my future videos instead of relying on the YouTube algorithm to serve them to you. Another small advantage of stocks is that you can basically buy them and hold them commission and tax-free. If you want to buy real estate, you have to pay a real estate agent, and even if you don't use one, you still have fees that can be up to a couple of percentages of the value of the deal. And then once you own the property, you owe different kinds of property taxes on it. With stocks, you can buy them literally for cents, regardless of how much money you invest, and then you are not charged anything for holding them, neither by the brokerage firm nor the government. The next advantage really depends on where you live, so I will just explain it briefly. When you have a property that you own, you are liable and open to lawsuits for whatever damage that property has caused someone. If you're a standard shareholder of, let's say, a pharmaceutical company, and it turns out that this company has been lying about the side effects of one of its drugs and gets sued for billions of dollars, you are not at all personally liable. Yes, of course, your investment might suffer, but no one will hold you personally accountable for the event. By the way, since we're talking about stocks, if you want to check my favorite 4 stocks for the current economic and geopolitical environment we are in, you can find the report in the link in the description. The report is free and will be sent directly to your email address. It will always be up to date regardless of when you are watching this because I'm constantly updating it. The next advantage of stocks is something that I touched on when I talked about the compounding effect, and this is the fact that you can literally start with even $5. With real estate, you need hundreds of thousands or at least tens of thousands for a down payment if you're going to do it with a mortgage, whereas you can buy any stock you want with just a few $100s that you have saved from your salary last month. This makes investing in stocks, contrary to popular belief, way more accessible for the average person than real estate. Alright, so the last advantage of stocks compared to real estate is their liquidity. Liquidity is a term which means basically how fast an investment can be turned into cash. For stocks, the time that it takes is literally as fast as you can press a button. With real estate, you might not be able to sell the property for months. Even if you find a buyer who is ready to pay, there is still a process that you have to go through, which could be problematic if you need the money fast. Okay, so now the time has come for my conclusion and a summary of everything we talked about. I will try to visualize the advantages of each asset class right here on the screen. For real estate, the advantages are that it is a more inefficient market and you can get better bargains if you are able to obtain sufficient information. Also, you have more control when it comes to the property itself, but that comes with the negative that, as we spoke earlier, most of the things that actually influence the price and the demand from renters for the piece of real estate is not under your control. With real estate, you also have tax benefits depending on the country you live in. One of the biggest advantages of real estate is that you can use leverage pretty easily by simply going to the bank and asking for a mortgage. And the last one is that it is easier to understand for most people because it is less abstract than stocks. At the same time, you have to be careful about the familiarity bias that makes you think that simply because something is close to you, you understand it better and you have more control over it. Now to the advantages of stocks, especially dividend-paying ones. One of the main ones is the diversification you get with them. It's a lot easier to have a diversified portfolio which lowers your risk with stocks compared to real estate. Dividend stocks also compound your wealth faster than rental properties because you can purchase new shares even with small amounts, and those new shares give you more dividends with which you can purchase more shares which give you more dividends, etc., creating the famous so-called dividend snowball effect. The next advantage is that dividends are way more passive than rent, and so if you're seeking truly passive income, I think that's a better choice. Next, there are almost no commissions for buying stocks and no commissions or taxes for simply holding them, unlike with real estate. When owning stocks, you cannot get sued for something the company has done, which could be a potential problem for a property that you own. Next, you can start with a very small amount of money, unlike with real estate. And the last one is that you can instantly turn your stocks into cash if you need it, whereas things are not so fast and simple with real estate, where not only you might have to wait for a long time to get a buyer, but you also will be paying a couple of percentages for doing it. So what is my personal conclusion? As a person who owns both rental property and dividend-paying stocks, I personally have a higher part of my portfolio in individual companies and ETFs. That doesn't mean that I hate real estate or that I think it's a bad investment, even though it might sound like that in the video. I just think that it's overhyped, and once I got the knowledge of how the stock market and dividend stocks and ETFs in particular work, I just understood that real estate is not the best choice. Again, that doesn't mean that it's bad, and for me, it would be the second best choice, but it's not the first. Again, if you want help with your investment journey, I remind you about my free investing masterclass, for which you can find the link in the description. Also, make sure to check this video that should have appeared on your screen already in order to continue with your investing education, because knowledge is the most important variable for your success.